When a major government hikes import duties on precious metals to a record 15% just to stop its citizens from fleeing the banking system, a line has been crossed. When Western silver vaults in London and COMEX are drained of 762 million ounces, the global balance of power shifts. This is not a theoretical forecast. This is the reality playing out right now across India and China. Private wealth is entering a state of open rebellion against fiat currency. While Western retail investors chase tech stocks and paper promises, 2 billion people on the other side of the planet are quietly resetting the global monetary system from the bottom up. An ultimate currency event is approaching. The West is losing control of the pricing power, and this is where things get dangerous. To understand how the global monetary system breaks, we must first look at India. For generations, the Indian people have held a deep, unshakable truth. You do not trust the promises of politicians. You do not trust the local currency. You trust gold. It is not a hobby. It is an economic religion. But recently, the political elite tried to break that religion. The government in New Delhi blindsided the market by raising the total import duty on precious metals to a record 15%. The policy objective seemed logical on paper: protect the fiat rupee from depreciating, stabilize the nation's foreign exchange reserves, force private wealth to stay trapped inside the domestic banking system, where it could be tracked, taxed, and controlled. The bureaucrats expected the public to simply comply. They thought higher costs would crush the appetite for real assets, but they completely miscalculated the deep-seated psychology of the population, and this is where things began to backfire. Instead of freezing, the domestic market mutated. The immediate reaction was not fear, but strategic retaliation. Buying did not stop, it went underground. The sudden imposition of the tax disrupted the official supply chains, triggering an unprecedented wave of domestic profit-taking and alternative routing. Because of this massive internal shift, local physical gold prices did something that shocked Western analysts. It plunged into a historic $200 per ounce discount relative to the international spot price. Think about that anomaly. While the rest of the world watched gold trade at all-time highs, the internal Indian market was heavily discounting physical metal just to bypass the official grid. The government wanted to corner the market. Instead, they broke the pricing mechanism. And then came the next level of escalation. With official channels choked by a 15% penalty, smuggling operations did not just increase, they industrialized. Black market syndicates mobilized across the borders. The financial incentive was simply too massive to ignore, with illicit profit margins spiking to a staggering 18% virtually overnight. Gold completely decoupled from the formal banking rails. It transformed into a massive, parallel economic ghost system. Millions of ounces of wealth began moving through unregistered hands, completely invisible to central bank regulators, completely immune to government surveillance. The legendary resource investor Rick Rule recently pointed out this exact structural flaw. The wealthy merchants of Gujarat do not view an aggressive government tax as a barrier to entry. They do not sit around and complain. They look at a 15% tariff and they see an immediate 15% profit margin for logistics optimization. They do not fight the bureaucratic laws. They simply route around them. Because behind the headlines, the people of India are not engaging in reckless speculation. Their behavior is entirely rational. They look at the expanding fiscal deficits of the state. They feel the heavy weight of real inflation burning through their daily purchasing power, an inflation that is consistently much higher than any sanitized, doctored government spreadsheet dares to admit. They watch the relentless global printing of paper currency by every major central bank. They understand the mathematical endgame. They know that over a 1,000-year horizon, every single fiat currency ever created has eventually returned to its intrinsic value, zero. But physical gold has outlived every fallen empire, outlasted every hyperinflationary crisis, and survived every authoritarian tax decree in human history. It is the ultimate defensive tool because you cannot easily confiscate an asset that the legacy banking system cannot track. By trying to tax precious metals out of existence, New Delhi did not protect the integrity of the fiat rupee. They achieved the exact opposite. They proved to their citizens that the currency was vulnerable, and they dramatically accelerated the velocity of its rejection. The state demanded compliance, but the street chose a quiet rebellion. But here's what the mainstream financial press is completely missing. This aggressive, desperate flight out of paper wealth and into tangible assets is not isolated to the jewelry bazaars of Mumbai or the trading hubs of India.
The global financial architecture is being squeezed from multiple angles simultaneously. In fact, the unprecedented grassroots resistance building in India is only half of the macro equation. An even larger, highly coordinated institutional supply squeeze is currently being executed in the Far East, a systemic drain that is systematically targeting the core of Western industrial and monetary reserves. While Western mainstream media hyper-focuses on the Silicon Valley tech boom, an entirely different game is being played in the East. Retail investors in New York, London, and Paris are chasing paper gains. They are bidding up big tech valuations to historic, gravity-defying extremes. They stare at their screens convinced that wealth is purely digital. But that is not the real story. While the West buys the software, China is quietly, systematically buying up the physical hardware. They are executing the largest stealth siege on precious metals supply the world has ever witnessed. And the data backing this up is absolute. According to the official 2026 report from the Silver Institute, the global silver market has just plunged into its sixth consecutive year of severe structural deficit. Supply cannot keep up with demand. It hasn't for over half a decade. But instead of the price reflecting this reality on Western exchanges, something else is happening. The physical metal is simply leaving. The traditional Western backstops are crumbling. The registered vaults at the New York COMEX and the London Bullion Association are being systematically hollowed out. A staggering 762 million ounces of silver have completely vanished from Western inventories. To put that into perspective, that is roughly 9 months of total global mine production, wiped out, absorbed, gone. It is a wealth migration of historic proportions. Now, mainstream financial analysts will look at this and give you a very comfortable, non-threatening explanation. They will tell you this is purely an industrial story. They claim Beijing is accumulating silver for one simple reason: to feed its massive solar panel and green energy manufacturing sectors. It sounds reasonable, but behind the headlines, that comfortable narrative completely falls apart. Let's look at the actual engineering data. The global green energy sector has spent years optimizing its technology. They have successfully implemented thrifting processes, reducing the amount of physical silver required per solar cell by a massive 19%. Think about that. The tech is using significantly less silver per unit. Yet despite this massive technological leap, the total global supply shortage is still expanding. It is widening toward an unprecedented 46.3 million ounces this year alone. If the factories are thrifting, where is the rest of the metal going? This is the ultimate twist. China is not just buying silver as an industrial commodity. They are buying it because they understand its dual nature. They remember a fundamental rule of economics that Western paper traders have completely forgotten. Silver is an industrial bloodline, but it is also a monetary weapon. Yes, it is irreplaceable in high-tech infrastructure, advanced telecommunications, modern military hardware, and the explosive build-out of AI data centers. If you want a digital revolution, you must have the physical silver to conduct the electricity. But more importantly, on a purely financial level, silver is historically drastically undervalued relative to gold. The gold-to-silver ratio has been stretched like a rubber band. By aggressively absorbing every available physical ounce from London and New York, Eastern capital is executing a massive coordinated macroeconomic hedge. And this is where things get dangerous for the West. Beijing is systematically shifting its geopolitical risk completely away from the U.S. banking system. They are looking at their massive reserves of vulnerable, depreciating fiat U.S. dollars and government bonds, and they are converting them into unfreezable, tangible, non-custodial assets. They are preparing for a long-term structural standoff, a multipolar world where global trade corridors are disrupted and supply chains are weaponized. They know that in a deep geopolitical crisis, a mountain of paper promises can be frozen or inflated away with a single keystroke, but a physical vault filled with industrial and monetary metal cannot be deleted. The relentless eastward drain is creating a massive liquidity vacuum, and the artificial pricing mechanisms of the West are completely exposed. For years, Western institutions have suppressed the price of hard assets by trading infinite amounts of digital paper. But a synthetic contract is not a physical commodity. When the industrial hunger of the East collides with the structural depletion of Western vaults, the paper markets will face a reality check they cannot survive. Because when a true global shortage hits, you cannot settle a desperate manufacturing contract or a currency crisis with a piece of paper. This systematic drain is setting up a structural trap, a trap that is about to snap shut on Western retail investors who believe their wealth is safe just because it is stored in a digital account. Which brings us directly to the ultimate point of systemic failure. This relentless, silent migration of physical metal from west to east is not just an interesting shift in global inventory. It is an invisible mathematical trap for Western paper markets. For decades, institutional powerhouses in Wall Street and London have dictated the price of gold and silver using synthetic paper contracts. On major derivatives exchanges like the COMEX, traders buy and sell billions of dollars worth of silver every day that never actually leaves a vault. It's a highly leveraged game of digital musical chairs. The entire mechanism is built on a single assumption. It assumes that everyone will be content playing with digital digits on a screen. It assumes that nobody will actually show up at the vault and demand their physical property.
But that leverage only works when the vaults possess an adequate buffer of physical backup. Right now, an invisible liquidity trap is closing as physical silver continues to bleed out toward Shanghai, Mumbai, and regional eastern hubs. The underlying tangible backing behind those infinite paper contracts is evaporating. And this is where things get incredibly dangerous for the average retail investor in the West. Most investors in the United States and Europe suffer from a dangerous psychological blind spot. It is a phenomenon known as the liquidity illusion. You look at your brokerage account on your phone, you see your shares in a popular silver ETF, or perhaps a digital gold certificate backed by a respected institution. You feel secure. You look at the flashing green numbers, and you genuinely believe you own the asset. But behind the headlines, you do not own the metal. What you actually own is a digital claim check on a highly leveraged pool of assets. You own a promise from a financial counterparty, a promise that might look ironclad during stable times, but one that is mathematically guaranteed to fall apart when a real shortage hits the system. The reality that the financial establishment refuses to broadcast is staggering. The paper derivative system is leveraged at a ratio of hundreds of digital ounces to every single real physical ounce sitting inside an accessible vault. So ask yourself the hard question: what happens when the Western precious metals community finally wakes up and realizes that the physical backing is gone? What happens when industrial buyers, panicked by supply chain disruptions, circumvent the paper markets and demand immediate physical delivery of their silver? The answer is a catastrophic, systemic short squeeze, a frantic, chaotic stampede to convert digital promises into physical reality. But you cannot print physical silver to cover a paper short position. You cannot fulfill a manufacturing contract for advanced semiconductors or aerospace tech with a synthetic paper certificate. When the U.S. sovereign debt crisis reaches its inevitable mathematical breaking point and inflation begins to compound exponentially, these digital brokerage certificates will not protect your purchasing power. They will simply expose you to institutional counterparty default. In that environment, the illusion of paper liquidity shatters instantly. Only non-custodial assets, physical assets held entirely outside the legacy banking architecture, free from counterparty risk, will offer true wealth preservation. The historic artificial disconnect between manipulated paper prices on Wall Street and the raw physical reality of the physical market is about to snap. The physical demand will eventually break the paper pricing mechanism entirely. And when that breaking point arrives, the narrative will flip overnight. The final historic runaway from depreciating fiat currencies like the dollar and the euro will not be triggered by an official Federal Reserve announcement or a policy pivot from the European Central Bank. It is being driven right now, ounce by ounce, bar by bar, by the calculated actions of everyday citizens in the gold bazaars of Mumbai and institutional buyers on the trading floors of Shanghai. They are moving their wealth out of the fiat trap, sending a slow-motion monetary shockwave straight toward the heart of the Western financial system. The physical foundations are being pulled away from the Western investor base, yet the vast majority of retail watchers are completely blind to the trap until it snaps. Which brings us to the ultimate choice you have to make before the music stops completely. Ultimately, as the legendary resource investor Rick Rule consistently reminds us, the real narrative playing out right now is not that the price of gold and silver is rising. The real story is that the floor beneath our paper currency is actively sinking. The global East has made its definitive move. They have evaluated the financial landscape and chosen tangible, historical survival over digital trust. They are systematically accumulating the real, physical asset. Meanwhile, the vast majority of mainstream investors in the West remain completely trapped. They are holding nothing but synthetic paper receipts, counterparty promises, and expanding debt obligations. When central banks and 2 billion people across the world's most critical emerging economies are exchanging their fiat notes for physical metal at an unprecedented historic velocity, they are preparing for a macroeconomic reality that the Western financial media is desperately trying to ignore. Which leaves us with a stark, unavoidable question. Are they seeing a systemic breaking point that you are still blind to? Do they know something that you don't? The window of opportunity to protect your purchasing power outside of a fragile, over-leveraged banking architecture is closing. The global migration of physical wealth is happening right now, in real time, and the choice of how you position yourself is entirely yours. Do you trust the digital liquidity promises of Wall Street paper ETFs? Or do you follow the generational wisdom of the Gujarat merchants and secure hard, non-custodial physical assets before the vault doors lock for good? Let me know your strategy in the comments below. If you found value in this deep dive, make sure to hit the subscribe button right now. You cannot afford to miss our next upcoming analysis, where we will blow the lid off the severe margin squeeze crashing the mining sector, exposing exactly why most silver mining stocks are a massive liquidity trap for retail investors. Protect your wealth, stay ahead of the macro shift, and I will see you in the next video.